When the industry talks about a dearth of financing available for the small companies, what they're talking about is 80% of the small companies. I note that this dearth of financing isn't something I've experienced. For probably 80% of the financings that I've wanted to get invested in for the last 2 years, they've been oversubscribed.
Yeah.
So the market is doing a rational thing. It's beginning to discriminate in movie parlance between the good, the bad, and the truly ugly, which is helpful. I think that corrects itself. I think we're going to go into a full-fledged precious metals bull market, and after that, a full-fledged natural resources bull market, at which point in time the investors will be just as stupid as they were 15 years ago. But for now, capital allocation is taking place, and that's the sign of a very healthy market.
Rick, I would like to start with your views of U.S. central bank lowering interest rates for the first time in more than 4 years, with a bigger than usual cut, actually. My question is, how will this affect the markets, and do you see more cuts in the remainder of 2024?
Well, they jawboned this cut so much ahead of time that I think a lot of the impact of the rate cut was already factored in the market. Anybody who listened, they told you that they were going to cut rates. Consensus was 25, we got 50. So there was some follow through in equity markets, and of course, nice follow through in the gold market. Although the response was mooted because everybody knew for 3 months before what was going to happen. It's interesting to me, Lucian, that our government tells us that our economy is in such good shape. If it is in such good shape, why do we need a 50-point rate cut? So I think they said at least 3 things. The first thing is that the rate is political, not economic. They haven't admitted it, but their actions show it. The second thing is that they are as much concerned about the state of capital markets, which is to say debt and equity markets, as they are the state of the broad economy. And the third thing is that the broad economy is not in as good shape as they would have you believe. The broad economy is in great shape for an old, fat, bald, rich guy like me. Subsidized interest rates, very low interest rates, benefit people with access to credit and people with the education to use it. That is to say, guys like me. Is the government trying to subsidize guys like me? No. The truth is that the economy isn't working well for people in the bottom half of the demographic. Yes, there's a lot of jobs, and most people have to have 3 of them to make a living. For those people who vote, and they're going to be voting very quickly, the economy is not working well. And appealing to them, even by way of lies, is something that politicians have to do. What investors have to understand, separate and apart from the moral aspects of a rate cut, is that more cash in the economy simultaneously increases the near-term rewards and enhances the long-term risks. What the Fed has decided is that inflation is less important than politics. And as you make credit more freely available to people like me, you stimulate animal spirits at the same time that you increase the depreciation in the purchasing power of the US dollar, and B, the real return to savers after inflation. So investors need to take both of these circumstances into account. Investors, I think, Lucian, also need to take into account that while increases in liquidity and a decrease in the discount rate increases confidence and lowers the near-term probability of a liquidity squeeze or a market panic, it increases the impact of that in the longer term. So investors need to take into account the fact that this near-term party might carry with it a longer-term hangover. I'm not suggesting that you organize your whole life around panic and fear. I'm just suggesting that your listeners maintain enough liquidity that if the party ends, and some of that liquidity should be in gold, that they benefit from the circumstance, as opposed to being victimized by the circumstance.
You are in everyday communication with the CEOs and the market experts. I believe my listeners would like to hear how is the sentiment among them when it comes to potential market correction event or possibility of even big crash. Do you see that they are more cautious than before?
You know, Lucian, it's hilarious that you asked me that. When I was actively employed at Sprott, running their brokerage operations, I made it a point every quarter to call 25 or 30 business owners, both public and private. And I would say, how do you feel about the broad economy? Terrible. How do you feel about the direction of the US economy? Terrible. What's the outlook for your own business for the next 12 months? Wonderful. And I would say to them, you realize I'm having this conversation with 25 or 30 guys. And the answer is always the same. The world's going to hell in a handbasket, but my country's doing great. My company's doing great. And of course, collectively, you guys are the country. So you need to leaven some of this nervousness with the understanding that both the upsides and the downsides are concentrated. It would seem that among the audiences that you and I serve, Lucian, they're really responsive to Agora direct mail, which is to say, the world's going to end on Thursday, and here's how you can profit. Now, in direct answer to your question around talking to public company, resource company CEOs, the response really depends on the nature of the companies. For the very small companies, the exploration companies, which are out of favor, new cash is very difficult to come by.
Yeah.
Conversely, if they're prospect generators, if they're people who are generating exploration ideas and selling them to major mining companies, the demand for high quality exploration targets has never, ever, ever been better. People like Elemental Altus, EMX Royalty, Kennerland, Riverside, Mondoro, the prospect generators are seeing large intermediates and major mining companies cleaning them out of exploration projects. So what that means is that we are gearing up for exploration on the quality side to shift into high gear. And that will be reflected in the market. This year, maybe not. Next year, almost certainly. Among the larger companies, you'll recall that at our conference, we had Sean Boyd, former CEO and now chairman of Agnico Eagle. I had the ability to have him for lunch, separate and apart from all the attendees, where I could actually talk to him. We've known each other for 30 years. And he just basically looked me in the eye and said, Agnico Eagle is in the absolute flush years. We have a wonderful team of people who've been together for 20 years. We have solved all of our major operational problems. The gold price is going up so that our margins will increase faster than our costs. We have a wonderful pipeline because we invested for 10 years when nobody else did. And this sort of bullishness among the best companies, not just the biggest, but the best companies, is ubiquitous. When the industry talks about a dearth of financing available for the small companies, what they're talking about is 80% of the small companies. I note that this dearth of financing isn't something I've experienced. For probably 80% of the financings that I've wanted to get invested in for the last 2 years, they've been oversubscribed. Yeah. So the market is doing a rational thing. It's beginning to discriminate in movie parlance between the good, the bad, and the truly ugly, which is helpful. I think that corrects itself. I think we're going to go into a full-fledged precious metals bull market, and after that, a full-fledged natural resources bull market, at which point in time, the investors will be just as stupid as they were 15 years ago. But for now, capital allocation is taking place, and that's the sign of a very healthy market.
Yeah, agreed on the commodity bull market super cycle. I definitely agree on that. But let's say potential market crash really happens, the scenario really happens, and the recovery after that. What do you think, Rick, which commodities would recover first? Or actually, do you see some commodities decouple and not crash with the general markets?
No, what you find is if the crash that you're talking about takes the form of the 2008 crash, which is really a collapse in confidence and the removal of liquidity from the market, everything goes down. Yeah. Because the sell decision isn't made by Lucian. It's made by Lucian's margin clerk. And he or she doesn't care what you think about an asset class. They're just looking for a bid. So if you'll recall 2008, the gold market held up for 24 hours and then it fell apart too. They take no prisoners in that kind of war. What happens is that the most stable asset classes recover first. And if you look at the recovery of various financial markets in 2008, one of the first to recover was the gold market. Why? First of all, people go to gold in times of fear. It is an asset that isn't simultaneously somebody else's liability. You don't need to make a credit decision if you own gold. The second is that it was very obvious in the aftermath of the 2008 crash that the policy response would be to add counterfeit liquidity, which is to say to print, which obviously inures to the benefit of gold. The other asset classes that did well were very high quality short-term bonds, secure places to put cash to ride out the storm. The third asset class that did well was the largest industrial corporations in America, the most liquid markets with the best balance sheets and the best profit margins. In other words, there was a distinct flight to quality. What didn't recover for a very long time were tertiary assets, marginal assets. Sadly, there's no more marginal asset on the planet than a penny mining share. So if we have a real market crash, the asset class that your listeners are holding for maximum upside will deliver them, at least in the interim, maximum downside. And people need to understand that, which is why I ask people to have most of their portfolio in natural resources around beta, most of their portfolios around natural resources in the highest quality companies, with the most trading liquidity, with the best balance sheets, with current operating margins, and with their soundness and stability demonstrated by an earned dividend yield. I'm not saying to people, don't do what I did. I'm not saying to people, don't chase the 10 baggers, the 20 baggers, and the 30 baggers. Chase them with money that you can afford to lose. Chase them in circumstances where you are certain enough about the long-term future of the company that you can psychologically and financially weather a 50 or 60% share price decline should a bad market come.
Yeah, you told me at the beginning of the interview about the importance of having cash on the side. Do you believe that now is a good time to increase cash position and decrease equities exposure?
I think that depends on how much work you're willing to put into things and how opportunity constrained you are. I'm trying to allocate cash right now. I have too much cash. A wonderful problem, by the way.
Yeah.
If I were a normal human being, I would probably buy more gold, but I've been buying gold since the year 2000, actually since 1998. And I have a gold-centric portfolio. I don't need to buy more gold. What I am trying to do is increase my risk-on positions. The difficulty with that is that the private placement opportunities that I'm seeing aren't sufficiently attractive to induce me to part with my money. Specifically, I'm not getting very many warrants. And I love warrants. If you want me to speculate, you have to make it worth my while to take the risk. I'm also actively engaged in trying to increase my position in convertible preferreds. In circumstances where I give up some of my upside in return for eliminating most of my downside. The one area where I have been able to deploy capital, and this isn't available for most investors, is I have been able to buy privately tranches in the senior secured revolving credit facilities around major oil and gas and natural resource companies. Think of these as very high quality 366-day bonds. And I have been increasing my position in that because they've been available to me very, very aggressively. But I still have, by traditional standards, too much cash. For most people, the arithmetic involving cash is as follows. On a current basis, you are losing money. If, as an example, in the US dollar, you're in the benchmark savings instrument in the world, which is the US 10-year Treasury, the US government is paying you 4%. If you believe that the degradation of your purchasing power is accounted for by the CPI at 2.6%, you're making a 1.4% real yield, which in a historic sense isn't bad. If you believe, like I do, that the real deterioration of the purchasing power of the US dollar is about 7.5% compounded, it means that holding cash is costing you 3.5% of your purchasing power every year, which is not good. I stomach that because I have lived through several market panics in my life. And during those market panics, if I had liquidity when nobody else had it, I had both the tool and sometimes the courage to deploy that capital when nobody else was deploying theirs. In other words, I was able to take advantage of a market decline rather than being taken advantage of. And I regard the negative real yield on my savings to be an option premium on having the ability, having the access to that capital when other people have neither the capital nor the courage to use it. And I think that's an important consideration for every single listener